You know that insurance payment that comes out every month? Ever stop and think about what it really is? Most of us just see it as another bill, but it's so much more. It's actually a fascinating legal contract built on some very specific rules. So today, we're going to pull back the curtain on that agreement and really understand the safety net it's supposed to create for us.
All right, here's how we're going to break it all down. We'll start with the big why we even need insurance in the first place. Then we'll dig into the core promise it makes. After that, we're looking at the three huge pillars that hold it all together, the all-important rules of honesty, and the mechanisms that keep the system fair. And we'll wrap it all up by looking at your role in this contract. Let's get into it.
Okay, so first things first. Let's tackle the fundamental problem that insurance was literally invented to solve.
I mean, really think about it for a second. Why do we pay for this thing that, if we're lucky, we will never, ever have to use? It's kind of a strange concept when you put it like that, isn't it?
Well, the answer is pretty simple. It's because life is, well, it's completely unpredictable. Accidents happen, things break, people get sick. Any one of those events could be a financial catastrophe. Insurance is basically the system we've all built together to manage the financial shock of all that randomness.
So, if risk is the problem, insurance is our collective answer. But what exactly is that answer? What is the promise that's actually being made when you sign on the dotted line?
At its very heart, insurance is a promise that's sealed inside a contract. You, the insured, pay a fee, and we call that the premium. In return for your premium, the insurer promises to indemnify you if a specific bad thing happens. Now, indemnify is a bit of a legal term, but all it really means is they promise to make you financially whole again, to compensate you for your loss.
Now, the law actually splits this promise into two main categories. On one hand, you have life insurance, and as the name suggests, this covers risks related to human life. Life policies, health insurance, that kind of thing. On the other hand, you have general insurance, and that's, well, pretty much everything else. Your car, your house, your business, all of that falls under general insurance.
And this is not just some casual agreement, not by a long shot. The law takes this promise incredibly seriously. So seriously, in fact, that for a company to even get in the business of making these promises, it has to prove that it has some serious financial firepower. Just to give you an idea, to start a life insurance company, you need at least 150 million naira in share capital. And that's not just cash for running the business. It's more like a giant security deposit, making sure the insurer can actually pay out its claims.
And believe it or not, for general insurance, the bar is even higher. 200 million naira. The law demands this huge financial backing for one simple reason: to make absolutely certain that when it's time to pay a claim, the money is there. It just reinforces how big of a deal this contractual promise really is.
Okay, so how does this whole contract actually work day to day? Well, the whole system really rests on three foundational pillars that keep it fair and stable for everyone involved.
The first pillar is something called insurable interest. And the idea is simple. You've got to have skin in the game. You can only insure something if you personally would suffer a direct financial blow if it got damaged or destroyed. So no, you can't insure your neighbor's car and then hope they're a bad driver. It just doesn't work that way.
So here are a few perfect examples. A bank that loans you money has an insurable interest in your life. A company has an interest in a star employee whose absence would tank their profits. And, of course, the most obvious one, you have an insurable interest in your own stuff, your car, your home. This whole principle is what prevents insurance from just turning into a giant gambling scheme.
All right, pillar number 2 is the premium. This is your side of the bargain, and the law here is absolutely strict. There's a simple, non-negotiable rule: no premium, no cover, period. If you haven't paid that premium, your coverage is simply not active.
And that brings us to the third and final pillar, indemnity. Now, this one is probably the most misunderstood part of insurance. The whole goal of an insurance claim is to put you back in the exact same financial spot you were in just before the loss. It is absolutely not designed to make you richer. Here's a great way to think about it. Insurance is a reset button, not a jackpot. If your 10-year-old car gets totaled, the goal is to give you the value of that 10-year-old car, not a brand new one. This idea is crucial because it stops people from seeing a loss as a way to make a quick buck. So, we've got our pillars. But for the contract to work, both sides have to play by the rules. And this brings us to the all-important rules of honesty.
See, most normal contracts just require good faith, but insurance demands something called utmost good faith. It's a much, much higher standard of honesty. Why? Because you, the person getting the insurance, know everything about the risk you're asking them to cover. The insurer is relying completely on you to disclose all the important stuff, what they call material facts. If you hide a big health problem or the fact you use your car for work, that could be enough to void the entire contract.
Finally, the system has a couple of really smart built-in guardrails to make sure that principle of indemnity, of not profiting from a loss, is always upheld. It's all about keeping things fair. Let's look at these two, subrogation and contribution. They sound complex, but they're not. Let's say another driver crashes into your car. With subrogation, your insurer pays to fix your car right away, and then they go after the driver who was at fault to get that money back. This way, you get paid fast, but you don't get paid twice. Contribution is for when you have multiple policies on the same thing. If there's a loss, the insurers all chip in to cover it together. Again, it stops you from claiming the full amount from every single company and walking away with a profit. It's all about making you whole, but not more than whole.
So, after going through all these principles and rules, what's the big takeaway for you, the person actually holding the policy?
The most important thing to remember is this. Your insurance policy is not just a product you buy. It is a two-way legal partnership. The insurer is legally bound to pay your valid claims, and you are legally bound to act with that utmost good faith to pay your premium and to be honest. It's a carefully balanced two-way street.
And that really brings us to the final thought I want to leave you with. The next time you get that renewal notice in the mail, are you going to see it as just another bill you have to pay? Or will you see it for what it really is, your side of a partnership, one that's designed to bring just a little bit of certainty into a very uncertain world?